Okay, now we're ready to go. Now you can hear me, right? Can you see my screen?
Yep.
Okay.
Yeah.
So all rockets ready to launch. Let's get started. So welcome. Now, and as I said, I know this is going to be tricky given the time zone differences, but we're going to get through the semester. It's going to be as close to a real life semester as I can make it. And let me start by giving you a little bit of history of this class. I know you're not interested in history, but I'm going to give it to you anyway. I came to NYU in 1986. So I'm ancient. My kids tell me this all the time. I'm ancient. I've been around a long time. So I came to NYU in 1986, and I was given a class to teach. It was called Security Analysis. You guys heard of this class, Security Analysis? It's a class with actually a very long tradition. It was taught at Columbia University by a guy called Ben Graham. You heard of Ben Graham? One of the great things about being a teacher is always blessed by your students. And Ben Graham had a very famous student that I'm sure almost everybody in this room has heard of. You know who his most famous student was, right? Peter, who is it? Unmute yourself.
Warren Buffett.
Warren Buffett. Huh? So it's a class that's been around a long time. So 1986, fall, September of 1986, when I came to Stern, it wasn't even called Stern then, it was called the NYU School of Business. They gave me this class and said, you have to teach security analysis. And I took one look at the class and said, I'm not teaching this class. Not a great attitude for an assistant professor to take. But here's why I didn't want to teach the class. By 1986, it was showing its age. It was 4 weeks on stocks and 3 weeks on bonds and 2 weeks on options and 5 weeks on institutional detail. Like what? There was an entire session on listing requirements for the New York Stock Exchange. Teaching was so easy in the days before Wikipedia. I mean, you could actually spend 80 minutes talking about the 12 listing requirements and people took everything down and they came out of the room saying, that guy's a genius. I don't want to do that. So I went to the head of my department and said, I don't want to teach this class. He said, he was a good guy though. He said, what would you like to teach instead? I said, I'd like to teach a valuation class. He said, don't do it. There isn't enough stuff in valuation to fill a class. And you know what? In 1986, he was absolutely right. There was actually one book on valuation called Security Analysis, written by Ben Graham from the 1930s. There's no books on valuation, no classes on valuation. So he said, don't do it. But I really, really wanted to teach this class. And I discovered very early in my university life that the best way to get something done at a university is to actually do it subversively. Because if you try to get official permission to teach a class, you know what would happen, right? A committee would be formed. You guys have experiences with committees? You know what happens when committees get formed? They meet and they meet and they meet. They forget what they're meeting about, but they keep meeting. They're baby committees called subcommittees and subcommittees. And 40 years later, they come back to you and say, you have permission. But I'd have been too old to teach by then. So I told the head of the department, okay, I'll teach a security analysis class. And I walked in and taught a valuation class. Let's face it, they have no idea what I do in a classroom. Remember, this was 1986. There were no cameras, no recording devices. I could teach cooking for 15 weeks. They wouldn't have caught on. That was 1986. You know how long it took them to catch on that I wasn't teaching what they asked me to teach? In 2008, I get a call from the dean's office, 2008. They said, we hear you're teaching a valuation class. I said, yes, I've been doing it for 22 years. They said, we don't see that class listed anywhere on the course listings. And I said, that's easy to explain. I've been hijacking all these other classes you've been giving me and teaching valuation instead. They said, that's not right. We should call it valuation. I said, I agree. So if you look at the course listings at NYU, you will see valuation show up for the first time in 2008. But this semester, when I'm teaching valuation, this will be my 59th semester teaching valuation. And I'm going to say something about this class that will encapsulate how I think about valuation. Everything I know about valuation, I've learned in the course of teaching this class. Notice what I said. I didn't say I knew it before my first class. I've learned in the course of teaching my class. Because this is a pragmatic class. You cannot teach it in an ivory chain. Basically, you got to have the real world in your classroom. And it's played out in my class. And I'll give you examples. I told you September 86 was my first semester teaching this class. In October of 1987, I was actually teaching this class again. It was October 19th. I remember coming back from a class. And that time, NYU was actually downtown. It was actually the building right next to the American Stock Exchange. I came back from my class and I looked out of my window. I was on the 7th floor. I looked out and I saw that everybody from the American Stock Exchange trading floor was out on the street. I said, maybe a fire alarm went off. But you know what happened on October 19th of 1987 that drove everybody out onto the street? On that day, the S&P 500 dropped by 22% in one day. 22%. Think about it. That the equivalent now would be the market dropping 8,000 points in one day. 22%. But here's the rest of the story. 2 days later, I was back in the classroom. And guess what the first question I was asked was? How do you explain the entire market dropping 22% in one day? And guess what? You can't evade the question. We had to talk about it. Then you get to the 1990s, and what happened? You had the dot-com boom. Companies with no history, no revenues, a lot of visitors to the website were going public at $3, $4, $5 billion valuations. And guess what I was asked in class? How do you explain why Amazon.com, this is in 1997, when Amazon was a tiny money-losing company selling books. How can a company like Amazon.com be worth any money? And again, I couldn't avoid the question. I had to value Amazon.com in class, and I'm glad I did because everything I know about valuing young companies, I learned in the process of valuing Amazon. Then you get to the next decade. And in 2008, if you remember, there was a banking crisis. The banking crisis spilled over into every other company because if banks are in trouble, every other company feels the pain. And guess what? We had to talk about how does the value of a Coca-Cola or a Facebook or an Apple get affected by banks failing? And I had to talk about it in the context of my class. And then you get to the last decade. You need the social media revolution in markets. Get companies like Facebook and Twitter and Netflix go public. And what do they have? What is the first number that these companies, what's the most striking number about Facebook? Somebody put up their hand and tell me about Facebook. What's the most striking number about Facebook? A number you look at and say, oh my God, no company in history has ever done that. Anybody want to try? Joe?
The number, the number of users.
Number of users. How many users does it have? Do you know? If you count WhatsApp and Instagram as part of Facebook, it's got 2.5 billion users. Think about it. 1 in 3 human beings, and I'm including babies and human beings, is on Facebook. What's the most impressive thing about Netflix? 250 million subscribers. You see where I'm going? In the last decade, the big question was, when you have a company with lots of users, lots of subscribers, where in valuation do we reflect that? How do you value a user, a subscriber, a member? And guess what? I couldn't evade that question. I had to think about how do you value user. In 2017, I actually valued a Facebook user, a Netflix subscriber, an Amazon Prime member, because I had to. Last year, I taught this class in the spring. I started the class in New York for the first 6 weeks. When the class started, things were going swimmingly well. Markets were doing well. There was not a hint of crisis in the air, right? That was January 28th. We were getting these news stories about a virus in China, but we thought it was in cruise ships in China. That's where it was going to be. How little we knew. Because by the time we got to the middle of the semester, the world had come apart, not just in terms of an economic shutdown, but a market meltdown. We have to talk about how do you incorporate into the value of a company the fact that the entire world has shut down. Leading into the semester, I thought it would be a nice coasting semester, things are in the back. And guess what? The week before classes start, what happens? Thousands of people on a Reddit group called Wall Street Bets decide that they're going to take revenge on a hedge fund. And guess what? They pulled it off. At least so far. The story is still being told. And if you read my emails, and those of you who don't know, are not getting emails, I've been emailing you already 4 times in the last 4 weeks. My last email, I sent you the link to what I thought about GameStop. Why? Because I know that this is going to be part of the question. What does this mean? This is a class that lives in the real world. And you know what? Over the next 4.5 months, who knows what will happen? And whatever happens out there is going to be part of this class. I have never used a case study in a class. I think it's silly to do it. You know why? There are 45,000 live case studies out there. Every company is a live case study. Why would I need to go back to 1997 and find some example of one company valuing another company or one person valuing another company and try to use that as a case study when we have real companies in front of us? So what I'd like to do in this class is not just give you the logistics, but lay out the foundations for this class. And I'm going to say that even though this might seem like you're in a hurry to get to mechanics and get cash flows and growth rates and discount rates, this class matters a lot more than all of those classes in detail. So let me start with my first question. It's a question I often get asked. Why do you do valuation? Most people don't believe in valuation. I include, by most people, I'm not just including Wall Street Bets traders. Most people who claim to do valuation for a living don't believe in it. But he said they do it. They do it because it's their job. They do it to cover their rear ends. But if you caught them in an honest moment, say, what's Tesla's value? The reaction is, it's whatever the market says it is. So I'm going to start by telling you why I do valuation. I do valuation to fight the lemming in me. You guys heard of lemmings? Lemmings became famous or infamous in the 1950s when National Geographic filmed the most amazing sight. Thousands of ugly rat-like creatures gathered together on a cliff, ran right off the cliff into an ocean, and committed collective suicide. I know this is mythology. I get emails from people saying this doesn't happen, but that's a mythology. Let's think about why that happens. You can see why the first lemming did it, right? He was going too fast. He couldn't stop. He went off the cliff into the ocean. Incidentally, these guys can't swim, so that kind of seals the deal. Dead. Second lemming, too close to the first guy, also in the water, also dead. But I'd like you to put yourself in the shoes of the very last lemming in that group. I know lemmings don't wear shoes, but kind of hang in there with the analogy anyway. You're with me? You're running as fast as you can towards a cliff. You've seen your entire tribe disappear off that cliff. I would think you'd have second thoughts about what you were just planning to do, right? Your left brain, your right brain, whatever part's rational, saying, stop, don't do it. But then you hear this voice in the back of your head. You know what it's saying? They must know something that you don't. Remember those 7 words. They're the 7 most deadly words in investing in valuation. They must know something that I don't. You will hear it. You will hear it during this class. You will hear it for the rest of your lives when you invest. And I'll give you an example of how it plays out. One of the things you have to do in this class is pick a company to value. And I'm sure some of you will pick a company like Tesla. And let's face it, you pick a company like Tesla, you picked it for a reason. Its price has gone up. While you pick that stock and you sit down to value the company, let's say you come up with a value of 200, stocks trading at 600. Now, what's your rational side say? don't buy that stock, right? But you think of all those other people who've made money on Tesla. You say, they must know something that I don't. You know what you're going to do? You're going to revisit your valuation. You're going to change your growth rate, maybe push it up. You're going to increase your margins. Your 200 is going to become 250. It's going to become 300. It's going to become 500. In other words, you're going to find a way to get to whatever price you want. It's human nature. It's built into you. In fact, I'm going to argue the whole world of investors can be divided into 3 groups of lemmings. The first group I call proud lemmings. I'm a lemming and I'm proud to be a lemming. They're called momentum investors, but it's pretty much the same thing. The second group I call Yogi Bear lemmings. They think they're smarter than the average lemming. They know what the cliff is coming. They want to run to the very edge and veer away. And the third group is where I put myself. If you ask me to describe myself as an investor, see that second to last guy in that picture? It's a lemming with a life vest. That's all I aspire to be. That's what valuation gives me. It gives me a life vest, something to hold on to when everybody else changes their minds. So here's what I'm going to do. I'm going to close this page and I'm going to go back to the syllabus, because now that I've given you my reasons for doing valuation, let's lay out the logistical details of this class and talk a little bit about how the class is going to be structured. So this is part of your syllabus. I emailed it to you. First, obviously, this class is going to be entirely online. So when you think about office hours, you're not going to find me in my office because I'm in La Jolla. You're wherever you are. You're not going to be able to find me. I'm not going to be able to find you. But you can find me online. My email, usually the best way to get in touch with me is through my email, because I almost always respond. So use that. My homepage is where almost everything I do is, my spreadsheets, my data, even the class is on there. There will be office hours before class on Monday and Wednesday. As you know, I teach 3 classes back to back. I teach my corporate finance MBA class, the MBA valuation class, and your class back to back. But the hour before, which will be 11 to 12 New York time, will be office hours. I know that doesn't work for those of you who are in Asia or Europe. So I'm going to come up with a second set of office hours only for those people who are not able to make this, simply because of the time difference. Because 11 to 12 will be like the middle of the night for most of you. Now I also have a in my regular classes, I've always had this fair game principle. You know what it is? If you find me, I'm fair game. So if this were a regular class and I was teaching it at NYU, the task would be, if you found me on the elevator in a restroom, you could always ask me a question. That of course gets more difficult online, but don't just ask me questions during these office hours. Feel free to reach out to me if you have a question, an issue that comes up. We'll talk. I'm sorry, this is the wrong. I have to pull this. These are the wrong TAs. Now that I realize it. No, but I'll send you the TA list. Never mind. I'll send you the TA list as we get through. Let me do it right now. So you see the TAs for the class, and Nick and Olivia, who both took this class last year, so they know exactly how much torture I will put you through. So they know pretty much every question to every answer you get. So that's the setup for the class. Let's talk a little bit about what this class is about. And as I said, this to me is the most critical part of valuation. I told you I've been teaching valuation a long time. And you know, one of the most common questions I get asked about valuation is valuation an art or a science? So let's start with that question. No fair looking at my answers, so I want to put this question to you. In fact, let's break it up. Is valuation a science? I'm going to pick on somebody here. Thomas, is valuation a science? Thomas Kim. No. Antra, is valuation a science?
I would say no, because it's not universal, as you've mentioned. I think there's no one right answer with valuation.
Okay, now we're on to something. So let's make this simplest. Mathematics is science. Is mathematics a science? Peter?
Yes, I would say so.
In
Because
fact, it's
there's
the only pure science. In fact, mathematicians are convinced that the rest of us are imposters. So let's think about what it is about mathematics that makes it a science. I know this is going to sound insulting, but what's 2 plus 3? Karan, I'll put you on the spot. What's 2 plus 3?
5.
Don't think too long. It's 5. Whether I count my left hand, my right hand, calculator, computer, North Pole, South Pole, it's always the same answer. Mathematics is a science of absolutes. You get the inputs right, you get the output. If you get the output wrong, you must have done something wrong. Physics is mostly a science, right? I notice many of you are on upper floors of buildings. I'm not going to encourage you to do this, but if you found a way to open the window to wherever you are and jump out, how slowly or quickly you fall has nothing to do with your IQ or where you're going to get placed after your degree. You're going to fall. The laws of gravity are the laws of gravity. They apply to all of us. The essence of a science is you get the inputs right, you get the output right. And Antra brought this up already. In valuation, you can get every single input right, given what you know today, which is all you can know, and be hopelessly wrong on the output. I'll give you an example. Last year, and we'll talk a little bit about this, I valued Airbnb at the time of its IPO. I did the best I could with what I knew then. I made my projections and I came up with revenue growth and margins, and I came up with the value. But after I finished the valuation, I posted on my blog, somebody said, "Are you sure about this number?" And my response was, "Are you crazy? How can I be sure? I'm not God. Lots of things are out of my control." And in valuation, that's something worth remembering. This is not a science. You can get every single input right and be hopelessly wrong because you didn't see the COVID crisis coming. So you could have valued Marriott in January 2020 or Zoom in January 2020, and everything could have changed under you. Valuation can never be a science. See, that must make it an art, right? So let's take that apart. Is painting an art? I'm not talking about painting your house. I'm talking about paintings that hang up in the Louvre or the Met. Yeah, obviously, right? It's called fine art. But let's take apart what it is that makes an art, makes something an art. I remember about long time ago, there was a Picasso exhibit at the Met, and I took my oldest son. He's now 30, so he was 8 years old then. So it tells you a little bit about how long ago this was. I took him to the Met to see the Picasso exhibit. You know how long an 8-year-old lasts in a museum? Almost, you got to bribe them to get in, bribe them to stay, and bribe them to not leave. It lasted about 25 minutes. We come out and asked him a question. I said, "Ryan, what do you think about that?" He said, "I wasn't impressed, Dad." I said, "That was a Picasso exhibit. What do you mean you're not impressed?" He said, "This guy can't get the nose in the right place." Have you noticed about Picasso's? The nose comes out of the side of the head, the top of the head. It's almost like he was drugged or drunk, which given Picasso's history is probably both. If my son were in charge of appraising Picasso's, Picasso would be worth nothing. But for whatever reason, we've gathered together the Picasso's, especially Manet's, Van Gogh's. The essence of great art is you really cannot teach it. You can teach good art, passable art, but you cannot teach great art. You're either born a great artist or you're not. Thank God valuation is not an art, or I wasted 35 years of my life trying to teach something that cannot be taught. So it's not a science, it's not an art. What the heck is it? I'll give you the word I use to describe it. It's a craft. You know what comes closest to valuation? It's cooking. Think of how you master cooking. You could watch the Food Network 16 hours a day, chopped episode after chopped episode, followed by Bobby Flay, beat Bobby Flay, followed. You could read every cookbook known to man, but guess what? You won't cook a lick. To learn cooking, what do you have to do? You have to go into that room in your apartment called the kitchen. You've been avoiding that place for a long time because you've been doing takeout for so long. But Sebastian looks like he's in his kitchen. And you have to start cooking. And the first time you cook, guess what happens? Fire alarms go off. You're not going to eat that night, but you're going to learn something important about cooking. I remember the first time I scrambled eggs. Nobody told me I was supposed to spray the damn pan. I finished scrambling the eggs. They look really good, but they're stuck to the pan. Pan and eggs go in the trash, but I learned a very important lesson about eggs. You learn cooking by cooking. Valuation is a craft. So how do you learn valuation? Not by watching somebody talk about valuation or reading more about valuation, but by doing valuation. Do you know what I'm going to do? I'm going to force you to do valuation, partly on the class in terms of project, but that'll be one company. But every week for the next 15 weeks, I'm going to do a valuation of the week. Sounds fancy, but I'm going to pick a company to value, and it's going to be a company I'm interested in. So I'm already thinking about what I should do for this week. Maybe I'll do GameStop. I'll take my GameStop valuation and I'll put it up. And then I'm going to ask each and every one of you to value GameStop. And what's your reaction going to be? It's a first week of class. You haven't taught us valuation. I'm going to give it your best shot. And you can use my spreadsheet. You can download my numbers, change what you feel comfortable changing. And I'll create a Google shared spreadsheet. So this is going to come at you tomorrow. This is not an abstraction. I'm going to send you my GameStop valuation with a Google shared spreadsheet. And I'm going to ask you to enter your value for GameStop that you came up with by changing what you felt comfortable changing. And I'll predict here's what's going to happen. Many of you are going to be uncomfortable changing my numbers. You know why? Because you feel intimidated. Say, that guy must know more about me. He's been teaching valuation for 35 years. You're probably going to change a third decimal on a risk-free rate. It's everything else, I agree with you. And guess what you're going to find? Your value is very much like mine. In fact, I'll put up a histogram of what you show on your Google shared spreadsheet. Here's what it's going to look like in week one. Everybody's going to come up with a value just like mine. It's a big bar right around my value. Next week, I'll pick a different company. Maybe I'll pick PZ Cousins Nigeria. You never heard of that company, right? It's a consumer product company in Nigeria. You're saying, why are you going to Nigeria and picking a consumer product company to get as different from GameStop as I can? Each week I will pick a company and I will roam the world, roam across sectors, young companies, old companies. I'm going to value a company and I'm going to ask you to try your best. Now, before you freak out, I'm not going to grade you on it. I'm not going to force you to value a company. There are lots of parts of this class where I'm going to offer you a chance to go further if you want to. But I understand you have other choices, other options, other things to do with your life. And if you say, look, I just want to value one company for my project, I don't care about any of this, I'm completely okay with that. But remember, if your objective is learn valuation, the more companies you try your hands at, the better you're going to get at valuation. You never quite master a craft. You just get better at it. 35 years into valuation, I'm still learning. Every time I value a company, I learn something new about valuation, something different. Don't stop learning, because the craft, you can only get better if you keep trying. Second, I know what you expected to get out of this class, but I noticed your class is called equity valuation. Is that what the title of the class is? Equity valuation? I don't know what comes up with these names. I concocted this class for the MBAs. I never called it equity valuation. You know why? It's not just about valuing equities. What was your first when you took this class, what do you thought you were going to do? You thought we were going to value publicly traded companies, right? That's your vision of an equity valuation class. We're going to value Tesla, we're going to value GM, we're going to value GameStop, and we'll do all of that, but we're not going to stop there. My view of this class is about valuing just about anything that can be valued. That could be a stock, it could be a company, it could be a piece of a business. It could be a sports player. So if you're looking at a trade between Jared Goff, the Los Angeles Rams, there was a big exchange of quarterbacks, and I said which side came up with the better side of value. I'm going to argue that you can value just about anything that can be valued, any kind of business that is cash flow. So we're going to roam the spectrum, not just public companies, but private companies, not just developed market companies, but emerging market companies, not just mature companies, but also young companies. And we're not going to stop there. I'm going to introduce a notion called pricing. I'm going to talk about the difference between value and price in a minute. But I'm going to argue there are some things that cannot be valued. Let me not be mysterious. If you have an investment that doesn't have cash flows, it cannot be valued. What's the value of a Picasso? You can't value a Picasso, but you can price it. You're saying, what's the difference? You know how you price something? You look at what other people are paying for similar things, and you attach a price. How do we put a price on a Picasso? What does an appraiser do? They look at the vintage of the Picasso. They look at what other people are paying for Picassos. They adjust for whether this painting looks a little better or worse. But basically, pricing is not about putting a value. It's about putting a price. So collectibles cannot be priced. You ever, Mickey Mantle rookie card. You say, what's its value? I can't tell you what its value is, but I can tell you what it's priced at. Last week, I actually posted on going beyond financial assets, because we tend to talk a lot about stocks and bonds in most classes. But there's a whole array of investments that fall outside stocks and bonds. Currencies. What's the value of the dollar? A dollar cannot be valued. It's not an asset. It can be priced against other currencies. That's what an exchange rate is. We can talk about whether the exchange rate is fair or not given the pricing. And of course, with cryptos, this comes up. The most asked question I've had for the last decade, if I take all of the questions I've gotten asked across different kinds of investment, about Tesla, about GameStop, about everything, and the question I've been asked most often is, what's the value of Bitcoin? You know why the question makes no sense in the face of it? What is Bitcoin? It's not an asset. It's either a currency, if you believe it's a currency of the future, or it's a collectible, which is like gold. You cannot value Bitcoin. You can only price it. So we're going to talk about pricing techniques, because a lot of things you cannot value, you can price. And we're also going to talk about investments which have contingent cash flow. Sounds fancy, but let's say that you hear of a young pharmaceutical company or a biotechnology company. It's working on a vaccine for COVID. And this vaccine is going to be a single shot and 100% effective. It's showing huge promise, but it's still in stage 2 of the testing process. You see what I mean by contingent cash flows? What has to happen for this company to have a lot of value? The drug has to be approved. And if it is, it's a multi-billion-dollar company. But if in stage 2 or stage 3 something bad happens, it's entirely possible that the FDA shuts the drug down. It could be worth nothing. That's really an option. It's not a traditional asset. I'm going to talk about valuing assets like those where the cash flows are contingent on something happening. An oil company, Petrobras. You're familiar with Petrobras, the Brazilian oil company. Its biggest claim to fame is that it found all these reserves all around Brazil in the last 20 years. The only problem with Petrobras' reserves, they're incredibly expensive to extract from the ground. They're under shale, they're under oceans. It'll cost you $50, $60, maybe even $80 to get the oil out of the ground. And when they were found, the oil price was 100, but now it's down to 50. So you're saying they're worth nothing. It costs me $60 to get the oil out. The price is 50. I'll pay nothing for the reserves. That's not true though, right? Because if I give you the rights to those reserves for the next 20 years, even though the reserves are worth nothing now, why might you still pay for them? Because the oil price could go up. That's an option we're going to talk about applying. And this is what falls into the context of real options. What I'm trying to say is this is a class where we're going to look at all aspects of value, all aspects of pricing from different viewpoints, managers, investors, private equity investors, venture capital. And we're going to discover that there's a universality to everything in the process that no matter which perspective you bring to the table has to be followed. Since I talked a lot about value and price, let me zero in on the difference. We know what drives the value of an asset. We've known for a long time. It's cash flows, growth, and risk. That's it. You can dance around these as much as you want, but that's always been true. So that Venetian glassmaker in the 1400s or the 1500s who sold his glassmaking business, the person buying it based the value on cash flows, growth, and risk. The reason I'm emphasizing that Venetian glassmaker in the 1500s, there are people out there who act like we invented valuation 50 years ago with discounted cash flow models. Hey, guess what? People have been valuing businesses well before discounted cash flow models even showed up. They just give you a framework for bringing cash flows, growth, and risk. So that's what drives value. What drives price? Demand and supply. What drives demand and supply? Maybe it's fundamentals, cash flows, growth, and risk, but it could be mood, it could be momentum, it could even be revenge. You know what I'm talking about with revenge, right? What was the driving force last week in Wall Street bets pushing up GameStop? I actually went to that Reddit thread to see what people are posting. And Wall Street bets is a big group of people. Some are sensible, some are not. But the overriding message I got on the boards was, by doing this, what are we going to accomplish? Anybody?
They're going to bankrupt the funds that are short.
They're going to bankrupt a couple of hedge funds, even if in the process they were bankrupted themselves. You're saying that's not rational? Hey, it's completely rational. Revenge is just as old an emotion as greed. And what I'm trying to say is when you talk about price, all those forces come into play. So the value process is driven by cash flows, growth, and risk. The price process is driven by demand and supply and all these behavioral and psychological forces. You're saying, shouldn't the two be roughly equal? If you believe in efficient markets, that's what you buy into, right? That the value process and the pricing process deliver numbers that are roughly the same. But if you don't, the two processes can yield different numbers. Now, do you think I believe in efficient markets? I know it's an unfair question, but I think I've given you the clue as to whether I believe in efficient markets. How do you know I don't believe in efficient markets? Nick, you want to try?
Yes, I'd say maybe it's because of like the asymmetry of information present in the
It's
markets.
nothing as fancy. What's the class I'm teaching? It's valuation, right? If I believed in efficient markets, how long would this class last? 15 minutes.
Yeah.
Right? What's the value of GameStop in an efficient market? You open the paper, find what the stock price is. In an efficient market, the price is the best estimate of value, right? The very fact that I'm teaching this class tells you something about where I'm coming from. Doesn't mean I'm right. And I'm going to argue that we all believe in market efficiency eventually. But I do believe the pricing process and the value process can deliver different numbers. And we have to therefore be careful to use the right word. I'm going to drive you crazy on this one. And here's why. This morning, I got an email from a journalist at Bloomberg. And she was talking about Elon Musk being on Clubhouse. Now, the first time I was asked to be on Clubhouse was like a few weeks ago, and I didn't even know what Clubhouse was. I said, what club is this? And why would I come to here? Aren't we socially distancing? And Clubhouse is a social media platform that reaches a lot of young people who are interested in lots of different things. And if you've read the news, Elon Musk was on there, I think, yesterday. And while he was on there, he made some news. I said, that's a surprise. Elon Musk always makes news. He made news about GameStop and AMC and silver. And because he made news, the stock prices of all of those companies and silver went up. So she emailed me and said, how do you explain the fact that the valuation of AMC is affected by Elon Musk on Clubhouse? I didn't even respond to a question directly. I said, please rewrite this question. How do you explain the pricing of AMC being affected by Elon Musk? This has nothing to do with value. Because what's driving the value? What drives the value of AMC? Forget about the cash flows, growth, and risk. What is it that's driving the value? Whether we go back to movie theaters, whether we buy monthly subscriptions, there are business questions, right? None of that is changed by pushing up the stock price for AMC from $50 to $100. GameStop's problems don't come from its price being low. It comes from the fact that we buy our games online and we play our games online. Right? We play Fortnite. I don't, but no, if you play Fortnite, you don't go through a GameStop entry point to get there. Nothing that Wall Street Bets is doing is changing that fundamental. If you want to talk about price, let's talk about price. If you want to talk about value, but don't use the words interchangeably. Any questions on value versus price? Because this is something I'll come back to over and over again, like a dog with a bone. Because I want you by the end of this class to draw that contrast. Because most people who claim to do valuation are really doing pricing. I'll give you an example. An analyst who claims to use a price earnings ratio or an EV to EBITDA should never use the word value for what he or she did. You know why? How do you get a PE ratio, EV? You look at other companies like your company, look at what they trade for, you apply it to a company, nothing wrong with it, but you're pricing your company. Which brings me to a lesson that it took me a while to learn valuation. So here's what I'm going to do. If I can find, I'm going to put up a poll. Let's see if I can pull the poll up. Forget about it. My polling is not working, but let me make this an informal poll. There's no right answer, so don't look at your neighbor. I want you to think about yourself. If I asked you to describe yourself as a person, would you more naturally describe yourself as a number cruncher or a storyteller? What comes more easily to you, working with numbers or telling stories? Okay, as I said, no right answer. Think about it. I'm going to give you like 25 seconds to think about, because it shouldn't be that difficult. Most of us have known for a long time what we're more comfortable with, numbers or stories. Okay? You've had a chance to think, right? So put yourself into one of those two groups, because I'm going to come after each group in a minute. I'll join you. I'll go first. I knew what I was probably when I was 12, maybe 13 years old, right after my first English literature class. I was asked to read Moby Dick. And I did. I was a good kid. I came ready for a discussion of captains and whales. And 15 minutes into the discussion, I noticed nobody was talking about the whale. So I put up my hands and said, when are we going to talk about the whale? And I remember what the instructor said. She said, there is no whale. I said, what, did I read the wrong book? I distinctly remember a big fish going all the way through the book. She said, it's a metaphor. And my jaw dropped. And the rest of the class was about hidden meanings and stuff that I didn't even know had a meaning in the first place. And I remember coming out of the class with a singular conclusion. I said, never again am I going to subject myself to that kind of bullshit. And the rest of my high school life was laid out for me. I avoided the literature classes like the plague. It was Algebra 1, Algebra 2, Algebra 3 out of high school. And these were the good old days. You know what is true in the good old days? You went to college. You didn't have a core curriculum. You know what I'm talking about, right? It's the first 2 years of your college life. What were you asked to do? Take all these classes you didn't want to take, and you were told if you don't take these classes, you will not have a rounded education. Complete and total lie. You have to take a history class. You know why you have to take a history class? Because if you don't, the history department's got to be fired. Those days, you could actually take numbers classes after you get a numbers degree. Like what? Like engineering, like banking, like accounting. No, you had a numbers degree. And then you got a numbers job as a banker, an actuary, an engineer. And after about 4 or 5 years of plugging numbers into spreadsheets, you got sick and tired of it. So you know what you do? You quit and you come back to school. Most of those people were in my valuation class. I asked the same question in my valuation class. There are 200 people in that class. About 100 people put up their hands and said, we're recovering number crunchers, recovering engineers, recovering scientists, recovering mathematicians. They're back because they're tired of working with numbers. I said, what about the other 100? Go back to that 12-year-old literature class. There are people in that class who love hidden meaning stuff. You hung out with some of them, right? They're like the poets. My youngest son writes poetry. He showed me his first poem. I don't think he's going to show me anymore. He said, Dad, what do you think? I said, this looks very good, Kiran, but aren't the last words supposed to rhyme? To me, that's poetry. It's like nursery rhymes, right? I got stuck there. And I remember the look of total contempt he gave me. He said, Dad, you're not a poet. And I said, you're right. They love this hidden meaning stuff. They take literature 1, literature 2, literature 3. They go on to Yale to become history majors. They graduate, and then they discover that even Yale history majors don't get paid very much. So after about 4 or 5 years of poverty-stricken wages as a journalist or whatever else you do with that kind of major, they quit and they come back to school. They were in my class this morning as well. I had 100 number crunchers and roughly 100 storytellers, which is actually different. My usual balance is more number crunchers and storytellers, but this year it looks like it's split right down the middle. So if I asked you which of these two groups is going to have an easier time with this class, and many of you already selected, I hope, number crunching or storytelling. Who do you think is going to have an easier time with this class, the number crunchers or the storytellers? Valuation is all supposed to be about numbers in Excel spreadsheets, right? Many people say it's the number crunchers will have the easier time. I told you I've been teaching this class for a long time, 59 semesters. Every single semester, you know who I have more trouble with? The number crunchers. And here's why. A good valuation is a bridge between stories and numbers. You know what I mean by bridge between stories and numbers? You show me a valuation of a company, Airbnb, and you say my revenues will be 50 billion 10 years from now. And I ask you, why will your revenues be 50 billion? Here's the answer I don't want to hear, because you used a 40% growth rate for the first 5 years and 30% after that. That's not answering my question. I need your story for Airbnb as a company. Is it a hospitality company, a booking company that allows it to have 50 billion in revenues? Every number in your valuation has a story behind it. And every story you tell me about your company has to have a number that goes with it. I tell people, look, you give me 100 history majors, and I'm not kidding. I can teach them enough valuation in a day to essentially be able to do valuations tomorrow. You give me 100 engineers, I am completely and totally screwed. I'll give you the end game here. No matter which side you pick, here's what I hope your end game. If you're a number cruncher, I hope by the end of this class, you're willing to trust your imagination enough that you can be an imaginative number cruncher. If you're a storyteller, I hope by the end of this class, you feel comfortable enough with numbers that you can be a disciplined storyteller. That's what you need in valuation, is a combination of both skills. So here's my advice to you. Whatever your strong side is, preserve it, but work on your weak side. If you're naturally comfortable with numbers, as you value companies, think about the storytelling side. And I'll tell you, it's not going to be easy. I told you I came to this lesson late in my life. I'd been teaching valuation 6 years already when I realized I had a problem. I could value just about anything, but I had no faith. Strange word to use, but in the next page, you'll see why faith is so central to valuation. I had no faith. You know why? Because I could make the numbers do whatever I wanted them to do. I could raise the growth rate, lower the margins, nothing holding the numbers together. I had to teach myself storytelling. And during the course of this semester, what I'm going to do is I'm going to take you through how I learned to tell stories. Not because I think that's the right way for you to do it, but I think you need to figure out your own way of bringing your weak side up to par. Which brings me to this final theme, which is when you think about valuation, you think about stories and numbers. Ultimately, valuation is not an intellectual exercise. So when you tell me the value of a company, you have to have faith. And let me explain why faith is the word I use. Let me pick somebody in here, who I haven't picked on yet. Nick, you ready to be my guinea pig? Nick Leung.
Sure thing. Can you hear me?
Yep.
Awesome.
Where is that Nick who spoke just now? Where is
Oh,
it?
yeah. Yeah, it is.
Zillion. Oh, Zillion. Okay, go ahead. So let's say that you're my guinea pig. You have any favorite companies?
Favorite companies? I don't want to steal
company in mind.
Airbnb.
You pick any company.
Yeah.
What, Alibaba? It could be Tencent. It could be.
Yeah, let's go Alibaba for kicks.
Okay, let's pick Alibaba. Let's suppose you value Alibaba at $350 per share, and the stock is trading at $250. So you've done the valuation. The price is out there. To actually put money behind your valuation, you need faith in two things. First, you need faith in your valuation, right? You did the valuation, you put in the numbers, you know all the mechanics, but you have faith in your value. And what's the second thing you need faith in? For you to make money on Alibaba, what has to happen to the price?
What has to rise?
To 350, it's got to go from 253. You have to have faith that the market will correct its mistakes. You see why I've used the word faith, though? I don't know how many of you are religious, but you go to church or temple, and at the end of a sermon or whatever, you go up to the priest or the rabbi, whoever and you say, look, I've been coming to church or temple for the last 30 years or the last 10 years, because you're pretty young. Can you give me some proof that God exists? What are you going to get as an answer? No, you have to have faith. The essence of faith is that you cannot prove it. Do you know where I'm going? Somewhere during the course of this class, you're going to say, this discounted cash flow valuation is a lot of work. Can you give me some proof that if I do it, I will make money? I'm going to preempt that question. You know what I'm going to tell you? I'm going to give you the same answer the priest gave you, which is, I can't prove it. You got to have faith. And if you say, look, I don't have faith, I say, that's perfectly okay. Just buy an index fund. One of the things I'm going to talk about in the context of this class is why I have faith. Why I'm willing. And I'm not doing it to kind of get you to the same faith, because I can teach you the techniques, I can give you the tools, but I can't give you faith. And I don't want to. It's something you have to accumulate from within, from your own experiences. But I'm also going to be open about when my faith gets shaken. You say, what does that even mean? Let's say that you go out and buy Alibaba at 250 because you think it's worth 350. Stock drops to 220 the next day. What's the market doing? It's knocking on your door saying, do you still have faith? You might say, look, I have faith. I can keep going. But that's something that is part of markets. You will have faith. Your faith will get shaken. Some people, their faith gets broken. Now do you see why the GameStop episode has been so... It's put people off balance, even people who've been investing for a long time. You know why? Because they say, look, I could do everything right, but what if a bunch of people gathered together on a crowd platform, whether it's Reddit or somewhere else, and push Alibaba's price down to 150? So I want to tell you that my faith was not shaken. One of the reasons I wrote that post last week was I mean, you might not believe this, I never write for other people. I write for myself. It makes me find my balance, is because I said, look, I've got to find my balance. This is something that is changing the way prices move to value. It could affect my faith, and I've got to be open about it. So let's talk a little bit about the logistics of this class. In terms of the structure of the class, next session, I'm sorry, it's going crazy on me. Go back. Next class, we're going to spend some time talking about what I call the big picture of valuation, kind of lay the table on the different valuation approaches, intrinsic valuation, pricing. So next session, we're going to do that. That's covered by those slides in Introduction to Valuation, so please download and bring it with you. Then we're going to spend about 9 sessions, maybe 10, talking about the details of intrinsic value. What's cash flow, what's growth, what's risk. And you're going to get impatient. I know upfront that you will, because we will not value a single company. Along the way, we will talk about pieces of companies. How do I measure the risk in a particular company? But you're not going to see all the pieces come together, and you're going to get impatient. But you got to lay the foundations first. Once we've laid the foundations, we're going to talk about valuing companies. And I'm going to go company after company after company, young to old, developed, emerging market, public, private. We'll get plenty of companies to value. Once we're done with that, we're going to talk about pricing. I have no problems with people pricing companies. If you want to use PE ratios, that's perfectly okay, but let's do it right. Let's use the numbers better. How do we do pricing better? Intrinsic valuation, pricing. And then we're going to close off the technical part of the class by talking about, hey, how do we value these real options? A young biotech company, undeveloped natural resources. As kind of a closer to the class, I'm also going to talk about valuation in the context of acquisitions, where 2 keywords come up: control, synergy. What is the value of control? What's the value of synergy? I want to talk about in specifics. And I also want to talk about how do you change the value of a company. If you were to become the CEO of GameStop, how would you increase the value of the company? You're saying that's easy. The value's already gone up. No, the price has gone up. The value hasn't, right? Nothing's changed in the company. What would you do to change the value of the company? That's the structure of the class. In terms of pre-season prep, it's a little late because the season has already started. But as I said, the 3 skills I would like you to have, very basic skills, are skills in accounting, basic statistics, and basic finance. Can you do present value? So by now, your classes should have already prepared, but let's face it, accounting and statistics classes don't do a very good job of letting things stick. They're so caught up in their minutiae that they forget the big picture. Which is one reason I've created that accounting for non-accountants class on my website. So you go take a look, it's 5 hours of classes. So if your accounting is shaky, I'd strongly recommend you take that class. Same thing with the foundations class. And somewhere during the course of the semester, I'm going to do a statistics class. For those of you who took a statistics class but never quite understood why it mattered, I'm going to argue it's a skill set that's critical in the world we're in, where we have too much data rather than too little. Now, I'll also make a confession. I'm going to harass you for the rest of the semester. And that's the right word to use. You will hear from me pretty much every day until May 10th. And I'll structure how I'm going to harass you. Mondays, we'll have a class, and at the end of the class, you're going to get an email about the class. You're saying, why? If I was at the class? Well, you might have been physically at the class, but mentally absent, and I'm telling you, this is what we did. Tuesday, I'm going to put up the valuation of the week, the one I talked about, and I'm going to invite you to spend a week on that valuation with a Google Shared spreadsheet attached. Wednesday, again, we'll have a class and an email about the class. Thursday, I will nag you about what? There's a company, your big project for this class, you have to pick a company that you both value and price over the course of the semester. And every Thursday, I'm going to nag you, guilt you into catching up on the project, because I know exactly what you guys are going to do. Every week, I'm going to say, please, please, please keep up with the project. And you're going to say, right, there's 15 weeks left in the semester, 14, 13, I'll do it later. So this is my way of saying, hey, where are you? Are you caught up? On Friday, I'll put up what I call in practice webcast, a topical webcast, where I'll take something in valuation, estimating the cost of debt for a company and take a particular company, go through where I get the inputs. It's a mechanical webcast on how do you apply these things. On Saturday, you get a newsletter. Don't get too excited. There's no news in that newsletter. It's more like a GPS that tells you where we are in the class at the end of that week, where we're going. And on Sunday, I'll give you a preview of what's coming the next week. And then we'll repeat the process over and over again. Obviously, classes are going to be on Zoom, and there are a couple of ways you can help me. As you can see already, the problem with technology is technology. You live by technology, you die by it. You could already see even today's class, we had those glitches. The bigger problem is when you have a glitch and you don't even realize there's a glitch because you're talking to an empty screen and nobody knows them. So here are the things you can help me on. At the start of every class, remind me to start to record the class. So now I know this sounds like an imposition on you, but I wanted, because as I said, there are people who will not be able to take the class and forget to hit the record, the class doesn't get recorded. You're saying, why doesn't NYU make all of its classes automatically recorded? That's exactly the question I asked the IT people. You don't even know what, you don't even want to know what the answer they gave me was. It pissed me off no end. But the reality is if I don't hit the record button, it doesn't happen, so remind me. The second is if there are technical glitches during a class, my audio is starting to break down, let me know because I can always turn my video off and it can make the audio better. Okay. So the classes will be recorded. They will be available on NYU Classes, but it's not a platform I like. It'll also be on my website. It'll be available also as a downloadable file. And I'm also going to make a YouTube version of the class. The advantage of YouTube is it adapts to whatever your bandwidth is. So if you're watching a class on an iPhone and you're using a cell service, you don't want to stream from NYU Classes. It'll kill you. Your bill's going to be thousands of dollars. But with YouTube, it'll actually adapt to whatever your bandwidth is. So everything will show up in multiple platforms. You don't have to go to all of them. It's the same thing. But pick your poison and stick with it. I'll also put links to everything that class involves, lecture notes. So basically already got the packet, but I'll tell you which slides we used in that class. There'll be a post-class test that you can use to check to see whether you're okay with the class. And as for Zoom rules, you already see there are very few rules. I would like you to have your camera on. No, because I'll tell you it's personal because it's kind of depressing if I have 150 gray boxes and I can't see it. It actually makes me feel more like I'm in a classroom if I can see you. And while you come in muted, if you want to raise your hand, of course, if you're going to ask a question and raise an issue, put up your hand first because otherwise it can become a little chaotic. No. And class discussions are completely fair game. They're saying, do I need a book? No, you can live with the lecture notes. But if you need a book, I have 5 different books. And you say, which one should I pick? There's actually a link on the website which compares the books so you can pick the book that's right for you. So pick whatever fits your needs and your budget, but you don't need any of them, right? I don't know how many of you have Apple devices, you have an iPhone or an iPad. I actually created an app, a valuation app that called UValue that you can download on the Apple Store for and it comes with a money back guarantee. You know why? It's free. So if you don't like it, tough, you'll get your money back, but there's no money in the first place. But actually it does a pretty good job of valuing companies. And it'll do it for nothing. Give it a shot because it takes much of what we talked about. I will harass you. As I said, this class, there are multiple ways I can harass you. So there's a Google Calendar, which tells you when quizzes come up, when exams. Almost everything I do that is in real time about an issue like the GameStop, you will find on my blog first. So if you see links to my blog post, now go take a look. I do have a Twitter feed, and so don't expect me to be an Elon Musk on Twitter. So I'm not tweeting out. It's basically a direction of just posted this. So the Twitter feed is more for directing you to something else. And final thoughts. This is ultimately, there is that bottom line, which is I could tell you grades don't matter, but that's kind of a meaningless statement because grades do matter for you. And I will have to devise a way to find a way to grade you because here's what I'm looking for. If you can value just about anything, then I want you to get an A. If you can value most things, then I want you to get B+. If you can value some things, then it's C. If you can value nothing by the end of the class, then I've clearly failed at my job and you failed at your job and we're Now, hopefully none of you will fall and I can value nothing. So the way I will test you is to figure out how to separate those groups. So here's what you'll have to do. First is, if you remember in the Google shared spreadsheet, ask you, are you in a group yet? And that was a little preemptive, but no, so if you can find a group, and the groups can be anywhere from 4 to 7 people. Right? The group will work on, each person in the group has to pick a company. So the groups don't work on one company, each person picks their own company to value. And somewhere in the middle of the semester, I'm going to give you a one-time shot to get just feedback, no grading. So you can turn in your discounted cash flow valuation of a company and I'll tell you at least if there's something mechanically wrong or inconsistent in your valuation. Okay. It's optional if you decide that you are so okay with your valuation, don't need it, I'm okay too. At the end of the semester on May 10th, the last day of class, the group will turn in its project, which will be the valuation of all of your companies in your group, each person's valuation one after the other. In terms of individual work, there are 3 quizzes and a final exam. The 3 quizzes are 10% apiece. The final exam is 30%. The quizzes are all online for obvious reasons because we're online. And because of the time difference, they will be available on a particular day. So they will not be in the class time because that's really not fair, right? I mean, it's not fair. Andra woke up and it's what, 3 o'clock in the morning, Andra, whatever it is. To do a quiz or an exam in the middle of the night really doesn't make sense. So it'll be available for a long enough time period that you should be able to find a time that works for you. The quizzes will be each 1 hour. There'll be open book, open notes, and there'll be multiple choice, something I don't like doing. But given the size of the class and the fact that it's online, the quiz will be multiple choice, but not conventional multiple choice. There'll be my regular questions framed as multiple choice, which means there'll be only 5 multiple choice questions over 60 minutes. It's a lot of time for each multiple choice. So if you're just picking randomly, you're going to be done in a minute. So why did you give me the extra 59? That's fine too. You have an expected score of 20% then, right? You should at least get 1 of the 5 right. But the quizzes will, and if you miss a quiz, it's not the end of the world. I will take the 10% of that quiz and move it to whatever's left in the class. So if you miss the first quiz, the 10% will get moved to the second quiz, the third quiz, and the final. If you miss the second quiz, I'll move it to the third and the final. If you miss the third quiz, I'll move it to the final. I will never move quiz scores backwards. You know why? Because then you will get preempted or strategic quiz missing. So if you do really well in the first 2 quizzes, you try to make them weight more by missing the third quiz. I can't allow that. So the 10% will always get moved to the rest of the class. If you do take all 3 quizzes, there's a bonus, which is I will take your worst quiz and replace that quiz score with the average score on the remaining quizzes. So if you get a 3 on one of the quizzes and 90% of the remaining exams, I'll replace the 3 with a 9. On the groups, I'm going to let you guys find your own groups because I don't want to be responsible for intra-group dynamics, right? Because I can't police groups. I know it's tougher to meet as a group online, but you can set up Zoom sessions. There's very little group work involved. Most of the work in this group will be on your individual company. So you're saying, why the group? Here's why the group matters. Remember I said you have a group of, let's say you have a group of 5. Every person in the class, every person in the group picks a company. So you have 5 companies. Here's the constraint. At least one of those companies has to be money losing. And don't worry, this is all in another set of slides. I'll send it. At least one has to be money losing. At least one has to be high growth in terms of revenues. At least one has to be an emerging market company. Of course, you could load it all up on one person. You know what I mean by one person? You can give him the money losing, high growth, emerging market company. Now, Ola. Now, but be careful because you learn valuation by dealing with difficult to value companies. You want to spread the pain because that pain is how you will learn. So start thinking about companies to pick, and you don't have to pass them by me. So don't try to send me this company okay. Any company is okay as long as you meet those internal constraints. And the project starts as of right now. So pick your company. The sooner you pick your company, the easier your life will become in terms of being able to apply what we do in class on that company. Any questions before we end for the day? Nick, you have a question? No? Or you just, You lit up, so I just want to make sure. Jonathan, go ahead.
Hi, Professor. I was just a little bit confused by that last part. So you said if there's, let's say, a group of 5, there has to be at least 3 companies in there? Or is it just one company?
No, at least those 3 characteristics have to be met. Money losing, high growth, emerging market.
Oh, okay.
One company can meet more than one of those characteristics, right? So if you pick Airbnb, which 2 characteristics have you met? It's money losing and high growth.
High growth, yeah.
Right? If you pick Ola, you heard of Ola?
No, I haven't.
Indian ride sharing company. It's money losing, high growth, and emerging market. You're done. So this is not a difficult set of constraints to meet. And once you met the constraint, other people can still pick companies which are money losing, but at least one of those companies has to meet those characteristics.
Got it. Got it. Thank you.
Andreas?
Hi, yeah, I had a question on whether, since we're in the same group, are we allowed to help each other with evaluation?
Absolutely, absolutely. Right? I mean, that's the other reason for having a group is to have some kind of way, because there's no right answer. It's not like by helping each other, you get the right value, right? Right? You're still going to be trying, so of course. Salim? You have a question?
Yes, like in terms of the part of the relative valuation, why we still call it valuation here, where we're trying to define
no, that's not
it as
so it's pricing. So
pricing.
the pricing part would, yeah.
Okay. So like
basically,
why
go ahead.
I'm sorry. So why we usually call it still a valuation instead of a pricing when the outcome of these kind of valuation methods cannot be called as the value of
Yeah,
the
let's call
company.
it pricing. You're right. I shouldn't even use the word
Okay.
relative valuation. I just use it because it falls in intrinsic versus relative. Because in pricing, you're making a judgment based on what other people are paying, but it's really pricing. So you'll be using
Thank
PE
you.
ratios and comparable companies or EV to EBITDA. That's what the pricing part will bring. Tony?
Yeah, Professor, just to confirm, so for the group project, each group will pick 5 different companies according
No,
to
it
your...
depends on how many people there are in the group. If you're only 4 people, there'll be 4. If there are 7 people, it'll be 7.
Okay.
So don't pick a group of 7 and do 5 companies. That won't meet the requirements, right? Every person will have a company. So the number of companies you do will depend on the size of your group.
Okay.
Okay, folks, I will see you on Wednesday. So get ready for that email later today because we'll get the process rolling. Bye.
Thank you.
Thank you, Professor.
Thank you.
You're welcome.
Thank you, sir.
Thank you.
Thank
Thank you,
you.
Professor.
Bye-bye.
Thank you, Professor.
Thank you, Professor. Bye.
Thank you.
Take care.